Okay, so first of all, thank you very much for organizing this wonderful conference. It's a pleasure to be here in Mexico. So this paper is called How Collateral Laws Shape Lending and Sectoral Activity, and it's joint work with my colleague at Colombia, Charlie Calomiris, and with José Liberti and Jason Sturgess from DePaul University. So I'm going to start with some basic motivation. One of the key obstacles that firms face in emerging markets is lack of access to credit. And an important determinant of lack of access to credit is insufficient collateral. What's interesting is that banks in emerging markets tend to only lend against real estate assets. They rarely lend against other type of collateral assets such as machinery, inventory, or equipment. So let me give you an example. This is a report done by the World Bank about the financial sector in Chile, which is my home country. So according to the report, the financial sector in Chile is in relatively good shape, especially when compared to the other countries in the region. But one of the major shortcomings is that banks in Chile over-rely on real estate as collateral for business loans. So in this paper, we argue that the root of this problem has to do with collateral laws. The law makes a clear distinction between two types of assets: immovable assets, which are real estate, and movable assets, which are all the rest: machinery, inventory, accounts receivable, etc. And each country has collateral laws for immovable assets and then collateral laws for movable assets. The problem with emerging markets is that many of them have weak laws regarding movable assets that restrict the use of movable assets as collateral and makes it very hard for banks to lend against movable assets as collateral. And this has two problems. First of all, it reduces the debt capacity of movable assets. That is, it reduces their capacity of raising external finance. But secondly, it distorts production away from activities that are naturally intensive in movable assets. So in this paper, we got access to a proprietary data set of a global bank that operates a secure lending program for small and medium enterprises over 12 emerging markets in the world. We have detailed information about all the loans that are granted by this bank, but the really unique feature of the data set, and what separates us from the rest of the literature, is that we have information about the liquidation value of each asset that's being pledged as collateral. So this allows us to calculate for each loan the loan-to-value ratio, which means how many cents is this global bank lending against $1 worth of collateral. And we're going to use this loan-to-value ratio in order to measure the debt capacity of different assets. So in this paper, we're going to do three things. So the first thing we do is we're going to analyze how the lending standards of the same global bank vary across countries with very different collateral laws. And we're going to find two things. So first of all, the frequency of movable backed loans is much lower in countries with weak movable collateral laws, and moreover, the loan-to-value ratio, or the debt capacity, of movable backed loans is also much lower in countries with weak collateral laws. When we look at the loan-to-value of real estate assets, we observe that it's more or less the same across different countries. Now this is purely a cross-sectional analysis, and one could be worried that our results are driven by some unobserved country characteristic. So in order to deal with this issue, what we do is we take advantage of the fact that one of the 12 emerging markets in our sample, Slovakia, actually implemented a big collateral reform in the middle of our sample period. So we take advantage of this, and we find that after the passage of this law, the loan-to-value of movable-backed loans in Slovakia increased substantially relative to real estate-backed loans. Now the third and final thing we do in this paper is we try to take the analysis one step further and analyze what are the consequences of collateral legislation on real economic activity. And we find two interesting things. So first of all, in countries that have weak collateral laws, they allocate much less of their overall production towards sectors that are naturally intensive in movable assets. And finally, when we look at the collateral reform in Slovakia, we find that after the reform was implemented, there was an important shift in the sector allocation towards sectors that are naturally intensive in movable assets. So let me start by explaining how we rank countries according to collateral law strength. So what we do is we follow the Doing Business project of the World Bank. So in every secure transaction, there's always three dimensions. The first of all is the creation of the security interest. The second is the perfection of the security interest, which means making sure that the public is aware about the existence of such security interest. And the third dimension is the enforcement of the interest in the event of default. So what the Doing Business project does is that it provides a questionnaire that's answered by a group of experts on 7 questions related to each of these 3 dimensions of secure transactions. So let me give you a couple of concrete examples. So for example, regarding creation, there's one question that is the following. Does the law allow to create a security interest over a movable asset without a specific description of the collateral? And this feature is key for an asset such as inventory that's turning around all the time. Inventory does not have a serial number like a ship, a bus, or a machine. So when the law requires a specific description of the collateral, it's making it very hard for banks to lend against inventory. Regarding perfection, the question is whether the country has an electronic collateral registry in place to register the security interest over movable assets. So for example, in the case of Mexico, I believe this thing is called RUG, which is the Registro Único de Garantías Mobiliarias. The problem is that without such registry, it's very hard for the bank to verify whether an asset has been previously pledged to another bank or not. And obviously that's a problem. And finally, regarding enforcement, the question is whether the law allows the creditor, in the event of default, to repossess the collateral without having to go to court, directly with the firm, with self-help. And this relates to some work that Jacopo, who's going to be my discussant, has done. This type of thing is particularly beneficial in places where the judicial system doesn't work very well and where courts are very congested. So we're going to create an index of movable collateral law for each country by summing the scores of these 7 different questions. And we have 12 countries in the sample. Some of them are from Latin America, some of them from Eastern Europe, others from Asia. So Chile would be an example of a country with weak collateral laws. The law in Chile makes it very hard for banks to lend against movable assets. Malaysia, on the other hand, would be an example of a country with strong collateral laws. The law makes it easier for banks to lend against movable assets. So for each of these 12 countries, we have detailed low-level information about all the loans that this global bank gives in that country. This is a secured lending program, which means that all loans are collateralized. So the first thing we do is we divide the collateral types into 2 types. Immovable assets, which is we're going to define as real estate assets. This is, think about land and buildings. And then movable assets, we're going to think about it as machinery, inventory, and accounts receivable. But as I mentioned earlier, the real novelty of this data set is that we have information about the liquidation value of each asset that's being pledged as collateral. And the way it works is that an independent appraiser of the bank determines the price that an informed buyer would be willing to pay to an informed seller when neither of the 2 parties are in a hurry to conclude the transaction. So we have more than 4,000 loans in the data set. Around 1,000 of them are backed by movable assets, and the remaining 3,000 by immovable assets. So consider dividing all countries into 2 groups, those above and below the median of the collateral law index. So for those countries above the median, this is the one we call strong law countries, the frequency of loans that are backed by movable assets is 31%. When we look at the weak law country, that frequency is 8 percentage points lower than in countries with strong collateral laws. Now, let me show you a table that describes the loan-to-value for each of the 12 countries by collateral type, immovable versus movable. The first thing we see is that for all countries, the loan-to-value of real estate assets is always greater than the loan-to-value for movable assets. And that's intuitive, because real estate assets are more redeployable, and therefore they have more alternative uses and higher debt capacity. Now, let's look at Malaysia, a country that's considered with strong collateral laws. In Malaysia, the loan-to-value for immovable assets is 84%. This means that on average, the global bank lends 84 cents against $1 worth of real estate in Malaysia. The loan-to-value for movable assets is 74%. It's a little low. Now consider Turkey, a country that has weak collateral laws. The loan-to-value for immovable assets of Turkey is very similar than what we observe in Malaysia. The real difference is here. The loan-to-value of movable assets, it's 47%, which is much lower than what we observe in Malaysia. So I can show this a little more clearly in a graph. So what I do here is for each country, I calculate the difference between the average loan-to-value of immovable and movable assets, and I'm going to plot that against the movable collateral law index of that country. And we're going to observe that there's a strong negative relationship between these two variables. What does this mean? So consider Chile, a country with weak collateral loss. In Chile, the loan-to-value of movable assets is much higher than the loan-to-value for real estate assets. When we consider Malaysia, a country with strong collateral loss, the loan-to-value of immovable assets is only a little higher than the loan-to-value for movable assets. We can analyze this even a little more formally doing a regression. So this is a cross-sectional difference in difference estimation in which we regress the loan-to-value of contract I on a law indicator that is equal to 1 if the collateral law index is above the median, a movable indicator, which is equal to 1 if the collateral being pledged is movable, and what we really care about, an interaction between the law indicator and the movable indicator. So this table reports the results and shows that this interaction term is positive and significant for different specifications. In English, this means that countries that have strong collateral loss, the difference between the loan-to-value of movable and immovable collateral is 27 percentage points higher than in countries with weak collateral loss. So this is a very large difference. The average loan-to-value of movable assets is 44%. So this effect actually accounts for more than 60% of such average. Now, as I mentioned before, the main threat to identification here is that there could be some unobserved country characteristic that correlates with movable collateral law of a country and that happens to affect movable assets particularly. So we take advantage, we deal with this problem by taking advantage that Slovakia, which is one of the 12 countries in our sample, did a very big collateral reform at the beginning of 2003. According to The Economist, after Slovakia implemented this reform, Slovakia ended up with one of the world's best rules on collateral. So what does this reform do? It improved all 3 dimensions of secure transactions. Regarding creation, it allowed to establish a security interest without having to transfer possession to the creditor. Regarding perfection, it created a super modern electronic registry to register movable assets, which made it very easy for banks to verify whether an asset has been pledged before or not. In minutes, this could be done. And regarding enforcement, it gave the option to the creditor to repossess the collateral in the event of default without having to go to court, with self-help, as long as there's no breach of peace. So in order to analyze the effects of this collateral reform, we're going to do a standard difference in difference test. And we're really looking at this, we're interested in this interaction term between a post indicator, which is equal to 1 after the collateral law was implemented, and the movable indicator, which is equal to 1 if the asset being pledged is movable. So this interaction term is positive and significant. It means that after the passage of the law, the difference between the loan-to-value of movable and immovable assets in Slovakia increased by 20 percentage points, which is a big change. And by the way, it's pretty similar in magnitude to what we observed in our cross-sectional regressions. Now, in order to provide further evidence about the causal effect of this reform, we're going to conduct a placebo test. The natural placebo candidate here is Czech Republic. Slovakia and Czech Republic were part of the same country in 1993, yet Czech Republic did not reform its collateral legal framework during this period. So what we do is we falsely assume that Czech Republic did reform in 2003. We do the same analysis for Czech Republic that we did for Slovakia, and we find absolutely nothing, which is reassuring. And what we have done until now is shown that collateral laws matter for the way banks lend in emerging markets. In the last part of the paper, we really want to take this to the next level and see what are the implications for the real side of the economy. And in order to do so, we're going to move beyond the global bank data, and we're going to use UNIDO data. So UNIDO provides sector-level information for 22 manufacturing sectors for different countries, and this information covers all firms operating in that sector, not only the ones that are borrowing from the global bank. And we have data for 10 of the 12 or 12 emerging markets. So the idea is that we think there's some sectors in the economy that are naturally more intensive in real estate than others, and therefore have naturally more real estate in order to pledge. So the question we're going to ask is, do countries with weak collateral laws actually overinvest in these type of sectors that are naturally intensive in real estate? And to answer this question, we're going to create a sectoral index of real estate intensity. And the way we're going to do it is as follows. For each sector in the economy, manufacturing sector, we're going to calculate the ratio of the value of land and buildings to total assets across all publicly traded companies in the US operating in that sector. Why companies from the US? Well, the US collateral law, which is called the Article 9 of the Uniform Commercial Code, is considered a piece of the art legislation regarding movable collateral laws. And therefore, we think that the asset composition of these publicly traded companies should be really unaffected by any legal friction. So, this picture here shows the real estate sectoral index for the 22 manufacturing sectors in the sample. We can see that there's quite a bit cross-sectional variation. So on one extreme, we have manufacturing of wood. Think about a lumber company operating a sawmill that naturally has a lot of real estate in order to pledge. On the other extreme, think about manufacturing of electrical machinery. This is a production process that's heavily dependent on equipment, but does not have too much real estate in order to pledge. So we divide all sectors in the economy into two groups, those above and those below the median of this real estate sectoral index. And what we do for each country, we calculate the fraction of overall manufacturing output that's being allocated towards this sector's intensive in real estate assets. And we plot it against the collateral law index of that country. And again, here we see a strong negative relationship between these two variables. So consider Chile, the country with weak collateral laws. In Chile, around 90% of all manufacturing output takes place in sectors that are intensive in real estate assets, and only 10% in the remaining sectors of the economy. When we look at Malaysia, on the other hand, that has strong collateral laws, the sectoral distribution is much more evenly distributed. We can do this more formally, doing another cross-country difference in difference regression, in which we regress the output share of a sector in a given country on the interaction term between the law indicator, which is equal to 1 if the collateral law index of that country is above the median, and a real estate indicator, which is equal to 1 if the real estate index of that sector is above the median. And we observe that this coefficient is negative and significant. It means that in countries with strong collateral laws, the output share of the typical real estate intensive sector is 1.4 percentage points lower than in countries with weak collateral laws. Now remember that there's 11 sectors that we have considered real estate intensive. So in the aggregate, this means that in countries with strong collateral laws, they allocate 15% less of their overall production towards sectors intensive in real estate compared to countries with weak collateral laws. So this is a large difference in the sectoral allocation of output across countries with strong and weak collateral laws. We control for a couple of observable characteristics such as GDP per capita. The results remain unchanged. We even try to do an IV exercise. So we use legal origin as an instrument for movable collateral law. When we look at the countries with weak collateral laws in our sample, Chile, Turkey, etc., they all have French legal origin. When we look at the countries with strong collateral laws, Malaysia, Singapore, Hong Kong, they all have English legal origin. So basically, we redo the estimation above using legal origin as an instrument for movable collateral law, and the results still hold. I don't want to push this too much, because I'm not sure whether the exclusion restriction would be very valid. But this is consistent evidence that collateral loss has an important effect on the sectoral distribution of the countries. Now, the last thing we do in the paper is we follow the evolution of the sectoral allocation of output in Slovakia around the collateral reform. And we find that before the reform, Slovakia allocated around 57% of its total manufacturing output towards sectors intensive in real estate. And after the passage of the law, that number declined steadily. And by 2008, it's 53%. This means that after the law was implemented, there was an important shift in the sector allocation towards sectors intensive in movable assets. So to conclude, because I'm out of time, as of today, there's still many emerging markets around the world that have weak laws for movable assets. This is problematic for two reasons. First, because the debt capacity of those movable assets is reduced, and secondly, because it distorts production away from activities that are naturally intensive in movable assets. So what we have done in this paper is we have analyzed how the lending standards of the same global bank vary across countries with very different collateral laws. What we find is that the global bank lends less against movable assets, both at the extensive and at the intensive margin, in countries with weak collateral laws. What we do next, you can sit here. What we do then is we zoom in into one of the 12 emerging markets that reformed and improved its legal collateral framework, and we find that after Slovakia implemented this reform, the global bank lends more against movable assets. And the final thing we show in this paper is that collateral loss not only affects the way banks lend in emerging markets, it actually also has important real-side consequences. And in particular, countries that have weak movable collateral laws end up allocating much less of their overall production towards sectors that are intensive in movable assets. And when we look at the sector allocation of Slovakia after the passage of the law, we observe that there's an important shift towards sectors that are intensive in movable assets. Thank you very much.
Okay, so thank you very much for inviting me to discuss this paper. I think this is a really interesting paper. So let me spend 2 slides on, and Mauricio already did a great job in presenting it. So let me spend 2 slides in kind of telling you what's the question they asked, whether we care about this question, and what do they find. And then I'll tell you, my take on this and potential lines of improvement. So they look at the effect of collateral laws on lending and sectoral allocation. When you think about collateral laws in their paper, you really have to think about all the legal framework that regulate the use of movable assets as collateral in loan contracts. So not just the laws in the books, but also the existence of a central registry, collateral registry, or the ability of resolve these issues out of court. When they look at lending, they look at the use by firms of movable versus immovable assets as collateral and LTV ratios. And finally, they look at sectoral allocation. Does this effect also affects the way the economic activity reshuffle reallocates in terms of output and employment across different sectors? So I don't need to convince you that this is a really important issue. So as Mauricio said, weak legal protection of creditors is a major source of financial frictions, especially in emerging economies. Why? They can limit access to external finance, which might prevent firms in these countries to adopt more productive technologies, to expand, to hire more people, and also is one of the potential sources of misallocation of resources in these countries. And I think the way they're pitching the paper now, going into this reallocation stuff, is really related to the whole misallocation litigation. So what do? They have this data on secured loans to small and medium firms issued by 1 banks in 12 emerging economies. They have countries from Asia to South America. They do a different if. So the first difference is these countries, it's across countries. These countries differ in the strength of movable collateral laws. So on one hand you have India, on the other you have Hong Kong, or Malaysia or Turkey in the example of Mauricio. And the second difference is the use of movable versus immovable collateral. And this is the difference across loans. You put these 2 differences together, and this is their main finding. You can actually back out their main findings from the summary statistic table of the paper, which I think is great. Okay, so this table shows you the loan-to-value ratio for a loan backed by movable assets. This is the average loan-to-value ratio for a loan backed by movable assets in weak low countries. Think about India, and in strong low countries. Think about Hong Kong. As Mauricio said, for $100 of value of a movable asset, you can get a loan of $82 in a country like India, $91 in Hong Kong. This difference is not that big. When you go to movable assets, the difference is huge. For the same $100 of collateral value in movable assets, in India you get a loan of $45. In Hong Kong, 83. So you do the standard diff and diff that you learn in -1, and you back out exactly the same coefficient that Mauricio showed you in these tables. This is the main findings of the paper. So my discussion. So the first thing I want to say is that if you read the acknowledgements of this paper, there's an army of discussants that already discussed this paper. So I'm kind of the residual claimant of whatever these guys have said. Nonetheless, I want to make some points on the way they use the data, particularly the data cleaning, measurement, identification, and interpretation of results. So I'm going to have 4 points. So my first point is about data and data cleaning. So this is the diff and diff result. I just show you a more regression framework, and I want to focus on the movable down equal to 1 if the loan is backed by movable assets. And what Mauricio showed you is that if you look at their sample, 73% of loans in their sample are backed by movable assets and 27% by movable. However, if you read the paper carefully, they're actually leaving out a bunch of loans that are backed by both movable and immovable assets. When you take them into consideration, 1,600 loans and 28% of their initial sample. When you take them into account, and now we have to think how to treat them in the analysis, but the first thing you see is that movable assets, most of the times, are used together with immovable assets. Most of the time. In addition, for these collateral laws Mauricio was talking about, they will also affect these guys, even though to a lesser extent. So you switch from a treatment 0-1 to a more discrete treatment. So my suggestion here is that you might want to discuss this in the paper, given it's an interesting finding, I think, and you have this probably a unique data set to show this. And you might also want to show the results when you assign a 1 to the movable dummy if some movable collateral is used. Just because also these guys are treated even though to a lesser extent. Of course, your estimated different coefficient is going to be lower, but that's not a big deal. But maybe you might also avoid leaving out some big countries that you are leaving out of the sample, like Brazil, South Korea, and South Africa. My second comment is about the other dummy in this definitive strategy, law C. This is a dummy called 1 if you are in a country that there's a strong laws that protect movable collateral, that favor the use of movable collateral. The authors are fully aware of the fact that using indices is kind of problematic. Adding 1 unit in this index, it's hard to interpret what it really means, right? So you're fully aware of that, but so the way you structure the paper right now, the paper is kind of silent about which features of this collateral law matter more, with the exception of the last part of the paper. And what I suggest you to do is to introduce these features one by one, so that it's possible to assess their relative importance. And what I think is going to happen is that for example, the out-of-court resolution is going to matter a lot. And one of the reasons I think this is that if you take the 12 countries in your sample and you look at time in court to resolve insolvency, right? And this is something that I took from the same data source that you use in the paper. And here you have 12 countries in your sample, years in court to resolve insolvency. You see that Hong Kong and Singapore, it takes less than a year. So the fact that you have the out-of-court resolution option doesn't really matter probably. Chile, Czech Republic, takes more than 5 years. That for sure it matters there. Comment number 3. Of course, we know this law dummies, this law measure is not randomly assigned across countries, and there are potential problem of endogenous sorting of firms into using movable versus immovable collateral. So instead of kind of pointing out potential biases here, I wanted to be constructive and just trying to think about a solution. And so I was thinking, why don't you use this? You have this other class of laws, these super collateral laws. What are those? So these are laws that are kind of insulated from country collateral laws. So they seem like the perfect control group for your analysis. So the ideal experiment here would be have 2 loans, same country, same type of collateral, because these loans can be backed by both types of collateral, same sector in which the firm operates. And one of these 2 is exposed to the regulation, the legal framework of the country, the other is not. But the question is, these super collateral loans are probably different in other dimensions. I don't know, but you can test that in the data. Maybe you can do a propensity score matching to create, a nice control group, and I think that would be a neat way to get around this endogeneity concern without having to go to the Slovak Republic, which is kind of a specific example. Okay, my last comment is about your finding on sectoral allocation, which I think is really interesting. Okay, so what they find is that weak law countries, think about India, tend to allocate more of their production in terms of employment and output into sectors that are more immovable intensive. How do we define sector as movable or immovable intensive? Well, we look at the US, that's what they do, and they look at the share of land and buildings over assets, and that's the picture that Mauricio showed you before, right? Where you have like food and beverages, tobacco on one side, and leather on this side. So the question here, you find a big effect, but the question is how much of this effect is actually driven by this collateral mechanism. Okay, so this really depends on how much the asset composition in production matches the collateral choice, not of the average firm in the US, but of these small firms in developing countries you are looking at. Okay, so so what I was thinking is, if you take the 2 extremes here, is really the small food producer in India more likely to use this house as collateral than the small leather producer? So I don't know the answer to this question, but I think the paper should think a little bit more about this issue. I have 1 minute, so let me just, so in terms of external validity, I think you have some great data. Maybe you can make an extra effort to convince the reader that this global bank, is really similar to other banks that operate in these financial markets. That would be useful. And I have like additional minor points that are about some controls. I can skip this. And this is like clustering technique. You have 12 clusters, the question is, what is the right amount of clusters? The ultimate answer to life, the universe, and everything is 42. So yeah, you're below that number, so you can do some fancy stuff like block clustering, block bootstrap, and stuff like that. Yeah, minor things I can send you the slide. I think in general this is a very important topic. You have this unique data set, and I kind of feel you're still not exploiting this in this full potential. However, this paper gives us new insights on the role of legal rules on choice of different types of collateral and on sectoral allocation. I see this as like the more promising avenue probably for this paper. And I look forward to the next iteration. Thank you very much.